Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Josh Lipton alongside Josh Schaefer, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here is your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We think the Fed has some signaling to provide market participants like us to say, hey, look, where should we be calibrating that equilibrium view? So we think the bias is probably more like 3.5. If the Fed were to go higher than that, that's really not priced in. We don't think this economy can withstand a really high terminal rate by the Fed. So again, the path is probably more important than the 50 versus 25. And so it's a very important press conference on Wednesday.
You're seeing still very solid consumption from the consumer, both on the good side. And when you take into account that 60 to 66%, 2/3 of spending is on services, well, services spending is still holding up too. So I don't think this changes really anything. It's kind of a non-event for us. We're still calling for 25 tomorrow.
Fresh all-time highs by the end of this year, no matter what happens in the US election. It would be relatively clear that a Trump presidency should be more positive, given he's been relatively constructive on Bitcoin in particular, but also the broader digital asset space over the last couple of years. So in his victory scenario, I predict we go to 125,000 for Bitcoin by the end of this year.
We've got 1 hour to go until the market close. We're taking a look at the major indices. And Josh, I cannot lie, there is not a whole lot going on this board today.
Muted.
We are looking at the Dow Jones off about 0.1%. Nasdaq's roughly flat. You can see we're a little bit higher earlier in the day, and the S&P 500 had been tracking for a record close at one point early in the day, but has traded a little bit lower. Main catalyst today felt like it was retail sales this morning, came in a little bit above expectations, but that seemed to do little to move how people were sort of reading the Fed going into tomorrow. Still looking at markets pricing an over 60% chance of a 50 basis point cut, and it feels like it's just a little bit of wait and see taking a look at all the majors right now.
I thought that retail sales was interesting, Josh, because you looked at that and retail sales surprised to the upside. Core retail sales, which are a direct input to GDP, rose 0.3%. If you're a central banker, if you're one of our policymakers, do you look at that and think, yes, a supersized half point is necessary?
I think some people look at it and you'd say 0.3% on the control, down from what it was over the last couple months, right? The headline number down. Maybe that is soft landing, right? Because when we talk soft landing, remember, we're talking an economy that's cooling, but not necessarily overheating or cooling too much. So that felt like a little bit of the read. I want to see if I can find oil on here for us, Josh. Here we go. That was one of the few things that's had a little bit of action today. It seemed like there was pickup in some tensions in the Middle East, and we saw oil rise off that. So that's been one of the few movers, but other than that, there hasn't been a lot really moving and shaking.
Yeah, I mean, the story for oil, and we've been talking about, Josh, has been a demand story, and just this shaky demand outlook for China, for the U.S. But today, you're right. I mean, maybe growing bets of a supersized cut, plus, as you noted, those geopolitical tensions
and real quick,
in Lebanon. Yep.
I want to take a look just at the sectors, and you can see energy, of course, getting a bid on that move in oil, but largely, again, not a lot of movement outside of what you're looking at from the S&P 500, not a lot of outperformance, not a lot of severe underperformance overall.
All right, let's get more perspective on these markets as we're now less than 24 hours away from the latest Fed decision. We want to welcome in Kevin Mon, Hennian and Wall CIO. Kevin, always great to have you on the show. Let's start right there, Kevin. Listen, Fed decision on deck. They want to know, Kevin, are we going to get the normal tried and true 25, or are we going to get the supersized 50? Kevin, what are you looking for?
I think we get 25 basis points. But with that said, I do believe they should have cut already back in July. And this would represent the second 25 basis point cut, which would lead us to 50 basis points. In fact, I believe in all likelihood, we revert back to their dot plot chart that we saw coming into 2024, which showed 3 rate cuts of 25 basis points each this year. Still 3 remaining meetings. We can still get those. 3 rate cuts of 25 basis points next year, and yet another 3 rate cuts of 25 basis points in 2026. Add it all up, we're 225 basis points lower by the end of 2026, and we get back down to a rate of between 3 and 3.25%.
And Kevin, there's all this debate about 25 or 50, right? And I think some might argue maybe that's a little bit short term and what it's going to mean for the markets. For a longer term investor, what should they be listening for tomorrow? What's going to be perhaps the broader takeaway once Powell starts speaking?
Really, how much damage has been done to the economy with the 525 basis points in rate hikes that have already taken place? If you look out a little bit further, I think it's clear, at least to the three of us, that rates are going to be lower, yields are going to be lower, and inflation is going to be lower over the course of the next 2 years. If investors have that mindset in that time frame, there's tremendous opportunities in both stocks and bonds. But if you try and play the Fed guessing game, is it 25? Is it 50? Are they going to cut 3 times this year? We don't know. We don't have a crystal ball. But if we look out further, the picture becomes a lot clearer.
Kevin, if the target is to get back to a 3 handle, why not just then start with 50 tomorrow? Get more aggressive, go big, get there faster.
Just everything we've heard from Chair Powell is that they want to be gradual and they want to be transparent with respect to the pace of these interest rate cuts. In fact, if we get those 3 rate cuts of 25 basis points this year, interest rates will still be at a 17-year high. Not as high as they were, a 22-year high, but still high. I think they become more gradual after that, perhaps just a quarterly 25 basis point cut next year, 4 of them next year, and then 2 in the following years. But we're going to learn a lot more from the Fed coming out of this meeting because we get an updated summary of economic projections and an updated plot chart.
Kevin, I want to pull up a chart for you. It's from Bank of America's Fund Managers Survey out this morning, and they had nearly 80% of respondents say that they feel like the global economy is headed for a soft landing in the next 12 months. That was the best reading we've seen going back to May 2023. And I think when you just look at the market moves over the last month, I've sort of been wondering, is the market almost priced too perfectly for a soft landing heading into this meeting, given that we're debating back and forth about whether or not they're going to be able to pull it off?
Yeah, I think if you include the Federal Reserve in that survey, that number would have actually been lower. Why do I say that? I looked to their last summary of economic projections, where they were forecasting economic growth to stay around 2% for the next 2.5 years. They're not forecasting their core inflation number, which we know is PCE, to get back to their target 2% until the end of 2026. Yet they're forecasting 225 basis points in cuts prior to getting back to their inflation target of 2% by the end of 2026. What gives? I think, Josh, they're more concerned with the threat of a hard landing than they are with inflation staying above 2%.
Do you think Kevin politics plays any role in this decision? I know that Jay Powell will hammer the table, the Fed's apolitical, but he has to know he does 50, there would be real political blowback on that.
And we also know that there are certain senators asking him to do even more. So there certainly are political pressures right here. But I think he has enough data, if they are data dependent, to support actually starting to ease with respect to interest rate. And we're going to see a gradual easing program over the next 2+ years.
And so given that, what sectors do you like here? I know you highlighted in your notes to us that utilities is a sector you like. I've been watching that sector go up, up, and up this year. Has it gone up enough at this point, or you still feel like there's opportunity?
Here's why I like utilities. One, they're generally known for paying attractive dividend yields. If, in fact, interest rates are coming down, all of a sudden these high dividend-paying stocks are going to look a lot more attractive. They also historically have a very defensive nature. I think there's going to be more short-term bouts of volatility ahead, if not for the presidential election, but because of the Fed guessing game once again. And finally, it is a backdoor play into the AI revolution. We know that these data centers run hot. They consume a lot of electricity. In fact, Josh, it's forecasted by the end of this decade, data centers alone are going to absorb roughly 10% of our country's entire electricity grid. But these data centers can't manufacture their own power. They have to go to the local utility in the states that they operate within. So I think for those 3 reasons, utilities are still attractive. But you have to look for attractive valuations, strong balance sheets, and diversified utilities that rely on electricity and natural gas.
So it's not a broad sector play.
It's not a broad sector play.
There's names you like within there.
So when you screen the utility sector, what comes up, Kevin?
So here's 3 names that we currently hold. Southern Company, a little pricey right now with a PE of around 27, but a dividend yield above 3%. Then I think of a company like Sempra Energy, has one of the largest utility customer bases, owns 80% of Oncor, and also is dominant in natural gas. And how about another one that we see like Sempra Energy, Southern, and NiSource. NiSource is another utility that not a lot of people know. 3% dividend yield, and a PE of less than 20. So there are opportunities there. Look for attractive valuations, strong balance sheets, positive free cash flow, a history of growing their dividends, and diversification with respect to their customer base.
And so we're talking a little bit about that broadening out trade here to some extent too, right? A rotation that we've been seeing in the market, sort of out of those Mag 7 names into those other sectors. Do you feel like that's the trend that's going to continue through the end of the year at this point?
I do, from the standpoint, if we start to see interest rate cuts, we're now going to see more and more attraction towards smaller cap stocks that really haven't partaken in this market rally just yet. You look at the top 4 performing sectors year to date. Utilities, number 1, over 20% year to date, having its best year thus far in over a decade. But then you look at names like financials, consumer staples, healthcare. 3 of those 4 are defensive in nature and very value oriented. So I think the market is sensing that there's going to be more volatility ahead. The growth oriented areas of the market are overpriced. Look for value, become a little bit more defensive, but don't exit the equity markets altogether.
Kevin, always great to see you in person, my friend.
My
great
pleasure.
to have you.
Thank you both.
We are just getting started here on market domination, and coming up, shares of Microsoft in focus today as the software giant announced it was boosting its dividend and approved a $60 billion stock buyback. Going to check in on some of the top trending tickers on the other side. And coming up at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, much more market domination still to come.
Now time for some of today's trending tickers, and you can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. We're taking a look at shares of Microsoft, the tech giant raising its dividend by 10% and announcing a $60 billion share buyback program. Shares up about 1% there. And Josh, another headline out of Microsoft that caught my eye yesterday. They're saying they're going to be putting more AI-powered Copilot technology across the 365 platforms. I see share buyback, I see raising dividends, and more plans to put AI into things.
Capital return AI, what more do you want?
That's sort of the AI picture, right? It seems like an overall positive story if you're an investor that's been sitting around waiting for AI to get more involved in the company's actual profits.
Yeah, it's one reason you've seen, for sure, Josh, and you're right to bring it up. Investors have moved into Microsoft because they see it as a smart way to play that mega AI trend. On the capital return news, Barron's pointing out Microsoft can afford the return to shareholders. The new dividend, they point out, should cost about $25 billion a year. Wall Street projects 2025 free cash flow of about $81 billion. So Satya Nadella can afford to send you that check in the mail every quarter.
And that's what shareholders want to see, right? When they're able to afford that, to boost that dividend, give them that money back, share buyback also going to help out there. And it's just a trend that we've been seeing in big tech over the last year. They had sort of that year of efficiency, right? And now you're seeing them start to return that money to shareholders and keep them in this for the long game, right? That's sort of the part that I think always comes to mind when you think about a dividend, is keeping the investors interested as they do sit and wait for AI to hit some of those profit centers. Keep them in
exactly.
the game.
And in a time of uncertainty, as we've been talking about, why not do a buyback if you're a CFO, right?
Always a good time.
All right, moving on. JP Morgan reportedly in talks to become the new Apple credit card issuer. This is according to the Wall Street Journal. So here's the story, Josh. So JP Morgan talked with Apple about taking over the iPhone maker's credit card program. Again, this is per the Journal. Says discussions started earlier this year. They've now advanced. Chief Executive Jamie Dimon, he's been briefed, Josh. That's how far this has gone. Now the Journal does put some caveats. No guarantee a deal is actually get done because kind of important things like the price apparently are still being negotiated, but interesting story here.
It just feels like a mega deal too, right? To see a bank like JP
Big
Morgan,
bank, big tech.
Big bank, big tech matching up, and you start to just think of the different things that they can sort of do together, right? As you get further integrated into things like Chase's rewards program and the availability of Apple products potentially in those and sort of how those types of things work. But overall, I mean, just for Apple to get any sort of boost in that services business, we know that services business is so big for them. So to keep moving this forward after the deal fell out with Goldman feels like an important story overall for them.
Yeah, that is the big backstory. You know, Apple and Goldman, current issue of the card, parted ways last year. So Apple looking for a new partner for the credit card, which, by the way, per the Journal, around 12 million users now, which jumped out at me. That was an impressive
that jumps
stat.
off the page a bit higher than I probably would have thought.
Yeah.
All right, taking a look now at Accenture, the professional services company reportedly delaying the bulk of its staff promotions. This, according to Bloomberg, shares down about 4% there, almost 5%. They're delaying them. They said in the release here that it is a move to just a permanently changing of their promotion date, Josh. So they're going to go from December to June, and that's the overall strategy here. I think zooming out, anytime you start to see this with the slowing down we've been talking about in the labor market, you just start to wonder, okay, is this a one-off for a company that's figuring out how they want to reoperate, or is it the start of a trend where you're going to start seeing promotions get delayed as more workers are staying at companies? That was one thing that stuck out to me here. But overall, it seems like they're sort of explaining it as just a basic move of, hey, we don't want to do promotions in December anymore. We're going to do them in June. We'll talk to you guys in June.
And Bloomberg, which has the story citing sources, does kind of place in this broader context of maybe just a sign, a signal of general uncertainty in this kind of professional services industry. Clients pulling back on spending. Peers, PricewaterhouseCoopers, Ernst & Young, McKinsey. Because remember, some of these companies did hire a lot during the pandemic to meet demand. Stock was hit today, now up just single digits a year, about 7%, Josh.
That'll be something to keep watching for, no doubt. All right, moving on. We got home builder confidence rising in September for the first time in 4 months. The reading coming in line with expectations and comes amid the backdrop of falling mortgage rates. For more, we're bringing in Jim Tobin, CEO of the National Association of Home Builders. And Jim, I just want to start with that rise for the first time in 4 months. I see something like that, and I think about those falling interest rates that we've been talking about, or the expectation for falling interest rates and mortgage rates. Is that what's driving that little bit of pickup in confidence that we're seeing?
Exactly, Josh. We're finally starting to see the light at the end of the tunnel with the anticipated news this week that we'll get some sort of rate cut, whether it's a quarter point or a half point, remains to be seen. But our members are starting to feel that optimism that we've seen peak interest rates, both in the mortgage space, but also with the Fed and therefore lending rates that our members use to buy land, develop land, and then put a home on it. So we're anticipating again some tailwinds here for the next several months.
And Jim, with the Fed, let's say they cut, Jim, they do a normal 25. What kind of impact does that have on the 30-year fixed?
I think we're going to start to see the confidence coming back into the bond market, and therefore we're going to see that whether it's a direct correlation between the Fed funds rate and mortgage rates, they don't move in sync normally. But we anticipate that just the good news about the economy that the Fed has finally decided to ease, I think that sends a signal that we are in for that soft landing that we've been talking about for a couple of years now. But more importantly, the Fed rate does translate into almost a one-for-one cut in those construction loans that our members use in order to buy and improve land and start projects. So that's really what the Fed means for home building in the short term.
And Jim, you bring up an interesting point there, because I feel like there's been so much talked about the mortgage rates, right? But is it those borrowing rates that is sort of what is holding back the overall housing market? Is that going to be kind of the key cog here rather than maybe mortgage rates falling?
Well, I think mortgage rates in the short term, mortgage rates are going to start getting people who have been sitting in their 3 or 4% mortgages in their existing homes off the sidelines a little bit more. They're going to start taking a little harder look at jumping back into the market, which means more competition for those new homes, which have had a pretty outsized portion of the market over the last couple of years. That said, I think we're still going to have land constrictions, land use constrictions from local governments. Material prices are still high. So we're still going to have some headwinds with trying to put new homes into the marketplace. But for us, I just think anything that's good news is going to start spurring that economic growth that we need. And as you know, both presidential candidates have talked about housing and new home supply, more importantly. So I think this all feeds into that idea that we're not going to be talking about housing for the next couple of years.
Jim, you mentioned those presidential candidates. I'm curious, Kamala Harris's proposal, $25,000 tax credit, cover the down payment cost, Jim, of first-time home buyers. What did you make of that? Good idea?
I think anybody who's talking about housing and supply, it's a good idea. I certainly have some concerns with the cost of these programs. As much as they are well-intentioned, we don't need any more demand-side stimulus. We need more supply-side stimulus. So that's why the vice president's plan to offer home builders a tax break to start building in that first-time space. I think that's really important. Again, talking about new supply or getting local governments to ease off housing regulations and make more land available. That's a good piece. You had former President Trump also talking about spurring that low end of the market as well as opening new federal lands to construction. So I think there is something there. But again, demand side, interest rates will take care of demand for us. Demand has always been there. Interest rates have kept that pent up for a couple of years. So we expect that as rates continue to fall over the next year or year and a half, we think demand's going to come back. And that's the time we need all those supply side stimulus so that we can get home builders back building again and meeting that demand.
Jim, there's a lot of debate on how much rates are going to fall over the next year or 2 years at this point, right? How much do you feel like rates need to fall or people need to feel like they're going to fall to start to bring that demand back?
We think rates settle into what we believe is the new normal sometime in 2026. And we think that new normal is about 5 to 5.5%. The days of 3 or 4% mortgages are gone, I'm afraid. So what we need to do is get this whole generation of buyers to recognize that 5.5% is still really cheap money historically when it comes to mortgage rates, and it's going to be a great time to buy your home. For those who bought earlier in the last couple of years, it's going to be an opportunity for them to refi. Of course, that bringing back that refi market for our mortgage banker friends is going to be important. But we are really looking for new originations and people who want to get out of their existing homes because of economic opportunity or just plain need to move to a different location. Those lower rates, again, probably over the next year and a half before they really get to the new lows. Even though we're touching close to 6 now, I still think we're going to see a lot of volatility over the course of the next year.
So, Jim, we're talking a lot about the affordability side of the equation. I'm just curious, back on the supply part, Jim, why aren't we building more homes in this country?
Well, I think it's a combination of, I talked about local land use. It's just hard to find developable land that's being allowed to be put into place by local governments. Then you have the permitting and the cost requirements that local governments put home builders through. Labor continues to be the biggest constriction. There just aren't enough construction workers in the workforce to help build those homes. And that, of course, when you have such a small labor pool, increases labor costs. And then finally, building material prices. They continue to be very volatile. While lumber prices are low right now, we're seeing gypsum or copper. Those prices continue to be high and bounce around. So there's a variety of factors that always seem to never get in alignment in order for to really spur construction. But again, I think with interest rates and this talk about having to put more supply, more and more local governments are getting that if you want economic growth, you have to solve for the housing equation. So I expect kind of a really good run up here over the next few years for home building in particular, just because demand's going to come back and our members are going to have to meet it.
Jim, a lot of trends for us to keep an eye on with you there. Hope to have you back again soon.
Thanks.
All right, coming up, it is the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, much more market domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. And today we're looking at the retail industry. U.S. retail sales did unexpectedly rise in August as investors keep an eye on signs of a consumer spending slowdown. So what's the best way to play the current state of retail? I'm here now with Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Brian, good to see you, my friend.
Thank you.
All right, let's sort of on a positive note. We're going to talk about what you like, Brian. And what you like for the first one here, this would be a buy in your opinion, TJX. And let's go through some of the reasons here, Brian. Your first point is a positive growth story. Walk us through it.
So on the headline number we got today for retail sales, you're talking about year over year, 2% growth in retail sales. We look at TJX companies and their revenue growth is up 6% on a year over year basis. So you're seeing a lot more capture in terms of the consumer's wallet share happening at TJX. Now, that's traditionally in TJ Maxx and Marshalls, their primary brands, capturing about 62% of that revenue. But Home Goods represents 17% of that revenue, and it's their fastest growing segment. So we see that 6% earnings growth as durable over the next several quarters.
All right, Home Goods. Second point here. Growth is promising over the long term, you say.
So they're developing a really aggressive growth strategy at TJX, opening as many as 1,300 new locations globally. It'll be primarily in North America and the EU, but they see that there's going to be more of a value-oriented consumer, stretching a dollar, as it were, looking for better values when they're out looking for those essential goods. This is a great marketplace for TJX.
All right, final point here, the reason you think this is a buy, solid margins.
Absolutely. So their margins have been pretty solid at a pre-tax level at 11%, but they actually went up 0.8% on a year-over-year basis. So again, growing revenue faster than the retail sales market, but also capturing more of it with better cost controls. This is a very strong story, in our opinion, over the next year or so.
And Brian, this stock, it's had a nice run already this year. It's up about 25%, but you obviously think valuation at these levels still attractive.
I think the real earnings growth is there, and that will attract those investors that are actually looking for that better relative earnings growth compared to their peer group.
All right, final point here. Let's talk about maybe some downside risks that viewers need to be aware of. Growth plans, you say, could be disrupted.
Well, it's one of those things where if their primary growth manner is going to be outside of the U.S., that means that they're ripe for some currency headwinds if our central bank cuts rates slower and lower over a longer period of time. That means the U.S. dollar could remain stronger for longer, and that creates some headwinds that they have to deal with just in the sheer currency exchange.
All right, so that's one you like. Let's turn to one you're not a fan of. This is one you would avoid, and that would be Target. Let's go through the reasons for this one. The first one, softening same-store sales, Brian.
So in that same relative comparison where you see TJX gaining wallet share, Target is losing it. Same-store sales down almost 4% on a year-over-year basis. And this is obviously a clear sign of a retailer that's not connecting with consumers in a positive way. One of the things that they have done is open up a two-front war with the big box retailers, Costco and Walmart, and now they discounted 5,000 essential goods items, and that creates another battlefront against things like Burlington and TJX. So what is Target going to be? And that's one of the reasons that I think consumers have kind of wobbled in their spending there, because they're not really sure where to go or what to expect from a price point.
All right,
at Target.
Second bullet point, Brian, the reason you would avoid this one, you say consumer confidence stalling.
So the long-term picture, retail sales up 2%, that's good, but the shorter-term month-over-month seems to be starting to stall. We're not getting the same month-over-month type of growth. And so in that moment in time, if there is a peak in consumer confidence or maybe even some wobbling consumer confidence, that means there's going to be even more competition for those dollars from the consumer, and they want to have confidence that they're going to be able to stretch their dollar as much as possible. So again, just all the signs pointing negatively against Target's future in the near term.
And final reason you would avoid this name, relentless competition.
Like I said, they've kind of brought this to themselves. They've opened up a two-front war against the big box retailers and the discounters, and Target really needs to choose a path forward on where they see themselves going. Obviously, they had some issues with inventory control coming out of COVID. They've tried to discount a lot of that inventory to keep it moving off of the shelf, but that's opened up, again, another line of competition. And if the economy does start to smooth out or stall, fall, it's going to be an even more competitive environment for those consumer dollars.
And it's interesting because unlike TJX, Brian, this one has not done much this year. You pull back the chart, year to date, stocks up, 6-7%, but even there, you don't want to kick the tires.
I don't. Again, it's the real revenue and the real earnings that are a warning sign here for the company. It doesn't mean it's going to go away forever and ever, but in the near term, they have some obstacles they need to overcome.
All right, so finally, let's talk about this. What's the upside risk to this call?
The upside is Target's aware of these obstacles that they need to deal with, and they are embarking on a digitization and optimization program that will help control some of these costs and right-size the inventory. Those benefits are seen far down the road, but the upside could be those cost savings materialize sooner than expected.
Brian, great to have you. Great discussion and great picks. Thank you so much.
Thank you.
And thank you so much for watching Goodbye or Goodbye. We'll be bringing you episodes at 3:30 p.m. Eastern.
Now let's get to some calls of the day, sponsored by Tasty Trade. Jefferies raising its price target on Teladoc Health from $8 to $10. The note highlighting the growth of BetterHelp web traffic. So Josh, BetterHelp web traffic picking up for the first time after 12 consecutive months of declines. That was in the month of July and August. And it seems like overall, Jefferies sort of pointing out here, they see a near-term catalyst for a trade. Stock's already up 12% and their price target's 10. They weren't necessarily saying that they feel like this is a long-term buy right now. Just wait and see what happens a little bit.
Yeah, right? they point this is a short-term opportunity in shares, they call it, amid very negative sentiment, 16% short interest. But to your point, Josh, they then do hammer home that point. Long-term, they say concerns may make it hard to sustain momentum. So they do stay on the sidelines. They do maintain that hold.
Yeah, and they point out that integrated care segment's going to be a key revenue sector to watch if you're looking to get into this name long term. Again, though, you zoom out on Teladoc over the last year, stock's down over about 50%. It has not been a very loved name in this market, and it seems like Jefferies isn't necessarily calling bottom on that quite yet.
Yeah, for sure. Moving on, here's another one we should check out. BofA Securities upgrading Hewlett-Packard Enterprise from neutral to buy. Note saying the company is well positioned in the AI space because of its liquid cooling technology. So they do like this one. Shares, they say, look attractive. The target set at 24. They talk about cost cuts driven by the new CFO, who they say had a proven track record at HPQ. They also highlight a cyclical recovery, they say, across servers, storage, and particularly networking, Josh.
Yeah, Josh, they're pointing out that valuation there, said it's trading at about 8 times 2025 earnings estimates. That's on the low end of its traditional trading range of 6 to 13 times. And when you see something like AI, possibility in AI, clear player and AI cooler, and then trading at an attractive valuation, that is not something we're talking a lot about in the market right now. So that adds up with how that gets an upgrade, right? Looking at about 40% on that price target there at 24.
You remember HP did recently report results, and we saw it come under some pressure on weaker than expected margins, but BofA likes it, valuation compelling, and many catalysts ahead, they say, Josh.
All right, Josh, something there to watch, Hewlett-Packard Enterprises. But we're going to take a look now at Bitcoin, hitting a 3-week high today as the crypto industry reacts to the Trump family's new platform, World Liberty Financial, and braces for tomorrow's rate cut decision from the Fed. Joining us now is Devin Ryan, Citizens JMP Director of Financial Technology and Research. Devin, appreciate you joining us in studio today. I mentioned off the top there, just Bitcoin at a 3-week high right now. What have you sort of been watching from trends within the crypto space now, where demand seems to be at for the crypto industry as a whole?
Yeah, hey Josh. So I would say it's been a volatile, obviously, the last month or so here. So we hit highs a little bit over a month ago in the low 70s and have come under some pressure. There's kind of two things going on. There's a macro conversation, and I do think that ahead of FOMC potentially lowering rates here tomorrow, that's going to be bullish, and so you're starting to see some positive move into that. And then there's also the kind of the political conversation, and with the Harris administration potentially gaining ground here, and there's not a lot of certainty around what an administration from her will look like. That's created, I think, some volatility in the space as well. So I think with getting on the other side of a rate cut, that's going to be one positive catalyst, and then getting some more clarity from a political perspective is going to be another one as well.
So tomorrow, Dev, we get, let's say we get a cut, we get dovish confidence guidance, we get dovish Jay Powell at the presser. You think Bitcoin reacts how?
Yeah, I think it's positive. So you take a step back, you look at risk assets, you look at, I cover fintech names and crypto names, and fintech has been under tremendous pressure over the last 2.5 years since the Fed started raising rates. Basket of companies we look at's down 50 to 75%. And I would say Bitcoin's done well for different reasons. When we get a cut, which it looks like we're going to, that is kind of more of a risk-on condition. And so we do think that's going to be good for the crypto ecosystem, probably drive more transaction activity. And then you can look at some of the fintech names as well, like a Robinhood, where we expect there's going to be more transactional activity. Retail engagement picks up generally in a lower rate environment as well.
And with the fintech space, how do you sort of think about it from a cut standpoint? There's a case where you get more cuts because the economy isn't doing well, right?
Yep.
And I don't know if that's necessarily a positive catalyst for fintech. So if you're an owner of one of these stocks, should you be rooting for more cuts, or maybe a few less cuts than we're looking at right now because it means the economy's doing well?
Yeah, it's a great point, Josh. I mean, it's the conditions around why you're seeing cuts, and you need a softish landing. That's what's going to be constructive for risk assets, not just the fintech stocks. But I think if that's the scenario, which right now is kind of more the narrative, I think, in the market, lower interest rates will be good. The other thing that's important, if you look at, as I talked about, there's kind of been this inverse correlation with fintech stocks and interest rates, because the fintech stocks that we covered 2-3 years ago were not profitable. And so companies that are higher risk, that when they're losing money, you essentially, those companies are going to have to borrow at very high interest rates. And so therefore, their cost of capital is higher. They're going to react negatively to higher interest rates. What's happened over the last 2.5 years, very interesting, is some of the really good companies have continue to grow revenues, they've cut expenses, and now they're profitable. So I think that risk has really been diminished. And so those companies, their stocks are up 100%, 150%. They're still not back to where they were at the kind of the 2021 highs, but the stocks that have not gotten to profitability in the fintech space are essentially still around the lows. So I think that just shows that there's been this divergence of both performance in terms of fundamentals, but then also why the interest rate piece matters. I think it's going to matter less because some of these companies have gotten to profitability, and so they've de-risked their future, and so therefore their cost of capital should be coming down. And
you mentioned Robinhood. You still like that name, Devin? Because what a run, 80% this year.
So I would argue that Robinhood is trading at about 11 times our 2025 EBITDA estimate. I think it should be trading about 2 times that. So you can make an argument that there's still a long way to go. They're growing revenues by 40% this year. They've already made more money in the first half of the year than they did in all of 2023. When I talk about companies getting to profitability, I'd put them at the top of the list. So they're both growing the top line, tremendous KPIs, and then they've gotten their expenses in check. 90% of their expense base is fixed. So that means that as they grow revenues, their expenses are going to grow a lot slower. There's a lot of leverage there. So stock's very cheap. If you can grow 40% top line, bottom line is going to grow a lot faster than that, and you're trading at 11 times EBITDA, there's a little bit of a mismatch there. So I think they're still proving it to the market. That's why you're able to buy it here. But we're bullish on their ability to execute, and so therefore, still quite a ways to go.
And shifting things back over to politics and thinking about the election and what it means for some of these stocks, I mean, is there a straight read-through on sort of what administration is going to be better in terms of maybe exchanges that are exposed to crypto, or is there not really a solid?
Yeah, so there's always second derivatives, and it's always so nuanced, right? But clearly, I think the Trump administration is running on less regulation, both in financial service markets, but then more broadly, right? So I think there is a mindset that is probably a friendlier administration for fintech, for crypto. That being said, because there is such, and this has been my position for a long time, because the voting bloc is becoming much more pro-crypto. There's more people that have exposure to crypto in the United States. They actually, you think about single-issue voters, they are going to be important in this election. And so I do think that when we get more policy from the Harris administration, it's going to be more constructive than the last 4 years. So that doesn't necessarily mean it's going to be, everything's going to be great that the industry wants, but I think we're moving the pendulum more toward the middle. So I think we're moving in a better position for the Coinbases of the world and firms that deal in the space. Arguably, I still think the Trump administration is probably a better outcome for the industry, but I think the industry can do well under either.
Let me, Devin, switching gears a bit. Earnings season is going to be here before we know it. Yep. 2 names I just wanted your take on, because you like Goldman, I know. Yep. You're neutral on Morgan Stanley. Explain why.
Yeah, so Goldman has really been a pure play on a capital markets recovery. So we've been in this incredibly depressed capital markets environment the last 2.5 years. I've done this for 20 years, and these have been really the 2 hardest years in my career, even harder than post-financial crisis. So if you think we're going to recover there, which lower interest rates, more risk on, and just purely time going by, Goldman's going to be more levered to that. On top of that, one of the things I've been pitching is they've made a huge push into asset management. Their alternatives business, which looks like the KKRs and Blackstones, they have $500 billion of AUM in that business alone. That's going to become a much bigger piece of their business model over the next few years. So that's the Goldman story. Morgan Stanley's great company. It's been stable, right? Wealth management's benefited from higher interest rates. As rates come down, you get a little bit of a headwind from interest rates. So what's been a benefit becomes a little bit of a headwind, and so they're less of a pure play on that capital markets story, which is why you want to own Goldman.
Devin, great to have you on the show as always. Thank you. Appreciate it.
Yeah. So,
coming up, oil prices rising higher today. We're going to break down the latest when market domination returns.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Oil moving higher today thanks to a combination of factors, including tomorrow's Fed decision, the impact of Hurricane Francine, and a series of blasts across Lebanon. We're joined now by Phil Strebel, Blue Line Futures Chief Market Strategist. Phil, always good to have you on the show. So oil moving higher today, Phil. What do you chalk that up to? As we just referenced there, is that growing expectations, Phil, that Jay Powell tomorrow is going to actually do a supersized 50? Is it the rising geopolitical tensions in Lebanon? What do you think?
I think it was. I mean, when you look at crude oil prices rising, it's two things. It's either increased demand or it's decreased supply. So obviously with Libya, with Lebanon, with the hurricane impact, I think that's what drove prices recently. We also had a massive short selling, opportunity in that market, and a lot of people got to come in and cover that. Just a week or two ago, oil prices were really signaling the possibility of a recession. Now, what's interesting is that they are expecting with a 63% chance that the Fed cuts 50 basis points here tomorrow, and many of the commodities and U.S. equities are elevated as a result of that. But I don't know if 50 basis points gives the right type of signal. Does it give the possibility that, we are headed for some darker times like a recession, ahead? And if you look at the 2025, kind of that balance sheet, it doesn't look so optimistic for oil prices. But then again, on the flip side, if we only get 25 basis points, then you could see the dollar index strength, and that could weigh in on not only crude oil prices, but also broad-based commodities such as gold, silver, and copper.
And Phil, so looking out into what we're going to hear from Chair Powell about maybe not just tomorrow, right, but we're going to get the SEP for the rest of the year, maybe make some projections into next year and start pontificating that way. We're looking at maybe 10 cuts over the next 2 years. What should investors be understanding about oil prices in terms of if the Fed is cutting more or the Fed is cutting less, and just simply what that will do to prices likely?
It's definitely the pace at which they cut is one of the most important factors. We do expect that they reach their terminal rate somewhere around next November, right at about 3 to 3.5%. How that can play a role, it could cause, investors to become more optimistic as far as more speculative in the market, and that could cause a broad-based recovery. I still think that many of those hardline factors like we're seeing with geopolitical risks and the supply-demand balance sheet are going to play much more of a bigger role. Also, China is one of the largest consumers, being the second largest economy. If they come out and they start to, follow suit and get a little bit more accommodative with their economy, you could see prices rise on that. So I think down at $65, I think we're a bit too low. I think north of $80, we're a bit too high. And I think it's really a trading affair around there. $75 being about the 200-day moving average right now.
Phil, what does this mean, bottom line, for prices at the pump? Where do you see gas prices headed, near intermediate term?
Yeah, it's been a real interesting dynamic because you go to different parts of the country, we see greatly skewed prices and things like that. If you look at Cushing in the Midwest, we've had 5 straight weeks of declines here. We had another big drawdown here last week. So across the Midwest, we're seeing that kind of impact. If you get back out to the West Coast, when you get closer down to Texas, you have those supply disruptions that are there. So prices are going to remain elevated. I think prices continue to hold firm going forward. And who knows? I mean, that could start to bring back those inflation talks, higher CPI numbers and things like that. So the Fed's really walking a tightrope right now, and no telling how things are going to play out.
Phil, I got to move over to gold because I'm looking at gold futures up over 25% this year. It has been a great year to be holding gold, but I also look at that number and I wonder, can gold really go that much higher from the record high we're looking at right now? How are you evaluating that?
Oh, I really believe so. I think a year-end price target for us is $2,750, and about a 12 to 15-month price target is $3,000. And it's always been that pace of the interest rate cuts that happen. You don't want to see a big interest rate cut if you are a gold investor because of the fact that it gets you closer to that terminal rate faster. You want to see a long, drawn-out process. You want to see a very long journey to get down to that level. So I think gold futures are pricing in 50 basis points. That's why we're at this elevated level. If they only cut 25 basis points, I think we could easily see a pullback down to about 25.50. Kind of your line in the sand on the gold market is down at a 25.20 down to 2,500. If we close below there, it could send off some warning signs that things are going to be a little bit shaky here and there. Who knows? Jerome Powell, he's thrown us some curveballs before where he does one thing and he comes out hawkish on the other ways. And I think with that higher CPI data, it wouldn't put it past me that he's going to be a little bit more firm in his discussion.
Phil, we're talking gold. What about silver? What do you see there?
Silver had a nice recovery with the copper market that they are really strongly correlated at the moment. 3250 is your key level of resistance. We did break out over that 3054 level, and it kind of puts us in a bit of no man's land. I know some of the coin dealers that I talked to, they expect prices to come back down to about $29, $28. So I would be a little bit more patient from here. I mean, can silver really rally without a strong Chinese economy, because they are one of the largest consumers there? I think that, you need to see them back in the action in order to really get things going. It has been a nice recovery on copper, with copper stocks being drawn down. Again, the correlation between silver's there, but again, without a Chinese recovery, you're going to see silver prices limited in nature.
Real quick, Phil, before I let you go, I got to get your take on copper.
Oh, I am not a believer in copper. I think it's a great hedge on the short side against many of the other metals that you own. So I am in the belief that, China's going to continue to struggle. The demand's not there, and prices are going to trend back down to $4.
All right, Phil Strebel, appreciate your insight there.
Thanks.
Well, we're wrapping up today's market domination. Do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
All right, and that's the closing bell on Wall Street. And now it's time for Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action in today's trade. Let's see where the major averages ended up, and it was not a very exciting day for the major averages. So the Dow Jones Industrial Average closing down about 0.2%, and then you take a look at the Nasdaq, almost exactly flat today, and then the S&P 500 down a little over 0.1%. One thing to note here, you did see the S&P 500 equal weight index outperforming that market cap index a little bit. So another sign of that broadening trade that we've been talking about, with more members of the S&P 500 performing better than the index itself. And a final thing I want to take a look at here, the Russell 2000 small caps. We know that the market has been shifting to pricing in a 50 basis point cut from the Federal Reserve tomorrow. Small caps have traditionally been performing well as the market looks for more cuts. You saw that today, small caps outperforming all three of the major indexes. But I want to get it over to Jared Blickery for a closer look at today's sector action.
Thank you, Josh. Not a whole lot of action in the major indices in today's section. We saw some action in pockets of the market, and as you noted, the Russell 2000 here got some liftoff. Just want to point out real quickly, the S&P 500 lost some steam around 2 p.m. pretty quickly. We actually had the greatest selling pressure in a few months. Didn't look like there was any obvious catalyst, but I would say heading into Fed Day tomorrow, a lot of times we head into these low liquidity events where people are just expecting to make a position or be in the market the next day or at some time, and well, you have these pockets of illiquidity and the price drops. So let's go to some of the sector action that we're seeing today, and it was not the best day for tech, but kind of in the middle of the field here. Energy was the best performing sector, up 1.33%. You can see healthcare down about 1%. That was the worst performer. Staples and real estate also down. So the tech plus the defensive sectors were the ones that took it, and the cyclical ones were the outperformers today. And the top performer was actually Bitcoin. Bitcoin up 4%. We also had small oil producers doing well. TAN is a solar ETF. Also, I should point to China, and maybe we'll have a chance to end there. China doing well, at least today, though not for the year. And it looks like software and Korean stocks, those kind of took it on the chin here. As promised, let's just close with a look at China. And it's been a while since I saw a screen like this with as much green. So I think investors will take that. Guys?
Jared, thank you. S&P 500 pulling back after hitting a fresh record as investors wait to find out whether the Fed will cut rates by 25 or 50 basis points. Joining us now is George Cipollone, Penn Mutual Asset Management Portfolio Manager. George, it's good to see you. That is the question. I'll put it to you. The Fed decision on deck, 25 or 50. You know, we had Greg Ip from the Journal on the show. And listen, he is in the camp that the Fed should cut by half a point. I think Greg was kind of making the point, really, with rates so far from neutral, labor markets weakening, they should go big. What do you think?
Hey, Josh, great to see you, and thank you for having me. So, yeah, I do agree with you, and it's I normally wouldn't want the Fed to do 50, but the only thing is the market shifted so much over the last week or so. If you look at the Fed funds rate and the expectations for the Fed funds rate, if you look at what the bond market's telling us, the gap between the 2-year and obviously the Fed funds rate right now is huge. It's as stark. It's going back to about 35 years in terms of how wide that is. And the only thing is, if you look back, obviously, it's going to tell the big difference in terms of how the market reacts is whether or not we are going to be in a recession or not. We clearly know that, and I know that's been said a lot of times. We're looking at plus 10 to 15% on the upside, or plus 10 to 15% on the downside. So quite a binary type of result. But the only two times in the last handful of decades that the Fed started off a rate cutting cycle with 50 basis points was 2001 and 2007. Both of those periods really were not great for the economy.
George, what if the Fed goes 25? It seems like there's a prevailing theory out there that might also cause a little bit of instability. Given the amount of data points we'd have to get between now and their next meeting in November, you're looking at 2 labor reports, several inflation reports. Would that make for a little bit more of a volatile period between their September meeting and the November meeting if they only go 25?
I agree with that statement 100%, Josh. And I think it's a great observation because, again, the market now is expecting 50, and it wasn't just last week. So I think last week my answer would have been a little different. And I'm okay with the incremental steps. I think the Fed's done a really good job in terms of just holding the line, not pivoting too soon. But now with the expectation of the market set, to your point, this is going to be the most uncertain FOMC meeting that we've had in recorded history, which only goes back to 2015. But still, it's going to be a very uncertain period. And I do think we have a gap potentially for volatility here if the market gets disappointed with 25 basis points.
And George, what about after this meeting? What does the pace of cuts look like ahead, do you think?
Yeah, sure. So there's a lot priced in, as we all know. There's a significant amount priced in, and there's not just 150 priced in. There are a few. So I've heard some people a lot smarter than me saying maybe 50 now, 25, and then 50 again at some point, depending on what the economy does. And I think that's the one clear point. So everybody needs to remember, why did the Fed hold the line so much? Well, we had inflation for the first time in decades. And so if you look right now, this will be the highest point inflation is at. the CPI core is at its highest point that it's been at the start of a Fed cut cycle in quite a long time, and really a long time. So right now we're around 2.5%. We're used to seeing it 2% or less at the start of this now. So we do not want to reaccelerate inflation. I know the Fed does not want to reaccelerate inflation, and I think that's the other tug, to their pull with this whole situation.
So, George, what do you like in this market then? It feels like it's been macro, and that's all we're sort of talking about for drivers for stocks here, right? But is there areas that maybe won't be as impacted no matter which way this goes with the Fed, or maybe which way it goes with the economy? Is there anywhere to hide, I guess?
It's a great question, Josh. And we are bottom-up investors, so we go company by company. And talking about macro, gosh, I mean, we really don't want to make a bet on the macro because who knows? There's so many variables that can change, and you could be so wrong sometimes. From a bottom-up perspective, you can absolutely see value, and we've done that. So just to your point, if you look at how concentrated the markets were over the last few years, that's created a lot of value for us across the market. And now it's starting to broaden, and we're seeing that. We're seeing value come back relative to growth. We're seeing utilities, for example, do better. I think they're up close to 20% just since the end of June. And so we're seeing these different areas. And so as value investors, that's what we're looking at. And some of these are even tied to the AI play, for example. Utilities are benefiting because, look, there's going to be a surge in energy demand. These businesses, if they grow as much as we think they're going to grow, if you look at the CapEx of the Mag 7 companies, I think it was over $50 billion over the last quarter. I mean, you're talking about a lot of money that's got to be spent. And it's going to be spent in infrastructure, and it's going to be spent in energy production. And so those are the areas that we think really look interesting, again, around that play, but more on the value side of it.
And George, so if it's not the Mag 7 participating, then what does that mean if I'm an index investor, right? If I'm someone that's investing in something broad, say the S&P 500, and we keep seeing this rotation, does that mean maybe more churn for people that are only investing in the benchmark?
Yep. Now I'm an active manager, but I will talk their book because I mean index funds really have protected investors a lot. Even in those times of ultra concentration, obviously the S&P kept going up, driven by just a few stocks. From a bottom-up investor's perspective, I do like the fact that the market's a lot more broader now. It certainly feels better. We certainly are performing better, and I think it's a sign of a healthier market. You don't want to just be caught in the whims of the market on one stock. And we kind of been that way, with NVIDIA's earnings, for example. And so now we're back to a little bit more broader market. If you look at growth expectations moving forward, it is a lot more balanced. So Mag 7 growth is starting, not that it's stalling out, but it's not as fast as the pace that it was before. And we're seeing other sectors kick up, like healthcare growth expectations, the materials, and other sectors.
And George, we talked a lot about monetary policy. Another big theme trend investors are clearly concentrating on is the election. Clients come to you, George. I'm sure you're getting questions about it. What are you telling them?
Yeah, it's tough. So I think one of the big things with elections, we love to tell investors and clients that, look, elections come and go. And we don't want to bet on one particular party. We do want to understand the policy, though. The policy is absolutely critical in understanding and the potential impacts of that. So we never try to judge or gauge one specific outcome. We'd like to know what all the possible outcomes might be. And then you weight them, from an odds standpoint and what is most likely. So if you think about either side, there's going to be certain policies that are good for specific sectors and stocks. If you just think of even crypto, for example, if, Trump wins, he's been talking about crypto and Bitcoin a lot recently. And then if you think about other policies, I think the big picture is that, the disappointing thing just from a citizen standpoint is that, the deficit spending is so high and it's contributed so much to GDP And, we all know what the national debt and the balance sheet looks like at this point in the interest cost. So we would love to see some fiscal responsibility, but nobody's running on that platform yet.
Something we'll definitely be keeping an eye out for, George, if we get more details on that. All right, appreciate you joining us today.
Thank you, Josh.
Meta introducing a new experience for teens on social media Instagram accounts. Teen accounts on Instagram are now to have built-in protections for safety and privacy for users. Joining us here with the details is Yahoo Finance's tech editor, Dan Howley. All right, Dan, what are the takeaways here? What should we know that teens are getting with these accounts?
Yeah, so there's a few things that are going to be happening here. Teens are going to be put into these kind of Instagram for teen accounts automatically. If the teen is under 16, they'll have to get their parents' permission to make any changes. Basically, these accounts are going to be extra strict. People aren't going to be able to message them if they don't already follow them, or they aren't already in touch with them. There's going to be reminders for teens to stop using the app after 60 minutes a day. There's going to be a sleep mode that will turn on between 10 p.m. and 7 a.m. that would mute notifications, and it'll limit the kind of sensitive content that teens are able to see, whether that's posts about fighting or those that promote cosmetic procedures in the Explore and Reels tab. So a number of changes here that they're trying to go with and address. There's also a bit about how they're going to try to get around or prevent teens from getting around how they are able to sign up for older, like adult accounts. Like if you're a teen and you say, well, I wasn't born in, how old are teens now?
You can make up your age.
I literally couldn't do the math right now. I was like, 2000? No, those people are in their 20s. But if you're like, if you're a teen now, you would just be able to fake your own time, date of birth, and instead what they'll be able to do is have AI to basically detect if those teens have done that. They're working on it. It's not foolproof at this point, but it's something that they're hoping can address this in the future.
A lot of times, Dan, it sounds like one criticism often is it's the content getting in front of the teens, the kids that shouldn't be there. I mean, are they addressing that issue too with all this?
I mean, that's the idea is, they won't be able to see this kind of content on the Reels page or in the Explore page. Yeah. But, I mean, like you can label content, a certain way. I mean, there's plenty of ways to get around this that, accounts do use. And so I think that's something that's going to continue to kind of bedevil Instagram, or at least parents of teens that use the platform. I mean,
Feels like a lot of loopholes here that you could potentially work around.
Yeah, right? And I think one of the things that Meta also points out is that this isn't bulletproof, and they need some kind of, they support legislation and yada yada yada, but it's easy to support legislation when it's not going to happen, right? Like if you can't get these people, Congress, to agree on privacy or cybersecurity legislation, how are you going to get them to agree on something like this? So, I mean, there have been calls from state attorneys general to have Congress allow the Surgeon General to affix a Surgeon General's warning label to social media. You can imagine how that's kind of gone over with the social media companies. So it's, this all comes down to what they say is the teen mental health crisis. Kids get on these platforms, they're addicted to them, and then they see things about, their bodies, they feel inadequate, or there's bullying. There was Frances Haugen who had come forward and said, Instagram knew that the app was hurting the mental health of girls, but just was like, "Beh." And so, these are things that still need to be addressed. This could be a way to at least fix some of those problems.
Lots to keep tracking there, Dan, with how this eventually plays out. Appreciate you joining us.
Thank you.
All right, coming up, the Federal Reserve facing a hefty decision at their policy meeting this week. We're breaking down what to expect and what comes next when market domination returns. The Federal Reserve facing a hefty decision at their policy meeting this week. Expectations are set for the central bank to reduce rates. However, the real question being the size of that upcoming rate cut. The Fed faced with a choice of a 0.5 percentage point or a traditional 0.25 percentage point cut for interest rates. Behind this rate decision comes concerns of what this means for the overall U.S. economy. And to break that down more, John Hilsenrath, Serpa Pinto advisor, founder, and author of Yellen, joins us now to discuss. John, I want to start with the market moves that we've seen over the last week. So last week, right about this time, it felt like we were pretty set on 25 basis points after that inflation print that we got. And then we had a couple reports come out, one from your former employer that seemed to maybe hint that the Fed was mulling this decision a little bit more than we thought. And we saw a massive move in markets. I mean, did that surprise you at all to see that big of a shift in sort of how markets were thinking about this?
Well, it was a little unusual. You know, every now and then you have these meetings where it's a tough decision. You have different members of the committee who have different views, and the data is coming at you kind of late and at the last minute, like right up to the blackout period. And that's what we had in this occasion. We had a jobs report that came out right before the Fed went into blackout. And the jobs report was mixed. The unemployment rate came down, but the payroll data were soft. The previous month, the unemployment data were soft and the payroll data weren't so soft. And then we had a new round of inflation data. So I think this has been one of those meetings where the Fed is going up to the last minutes, doing a lot of calibrating right as it's about to make a pretty big move, the first easing cycle in a long time. And so you're getting all this noise. You know, I think that what you need to do in a moment like this is pull the lens back. There's a lot of chatter. Well, are they going to do a quarter? Are they going to do a half? I think the really important point that people have to think is that the Fed is going to be doing a lot of easing over the next year. Forget about what happens next week, whether it's a quarter or a half. I think they're going to be reducing short-term rates by about 2 percentage points over the next 12 to 15-month period. Now, if you had asked officials back in June how long it would take them to reduce rates that much, they would have said it was going to take 2 years. So they're compressing a lot of interest rate cuts into a short period. And that's really what the big story is here, besides this kind of debate and chatter about 25 versus 50.
Let's say, John, you were back in your old beat and you were in that room tomorrow with Jay Powell in that presser. What questions would you have for him, John?
Oh, wow, that's a really good question. You know, I mean, I'm going to be honest with you. Some people get really hung up on those questions, and I think it's important. But to tell you the truth, the best questions that I had, I wasn't asking in front of a group of other reporters. But let me think. I mean, I think this would be my question. The Fed is on what I would call an express train to neutral. What does that mean? So right now, the Fed's benchmark interest rate is 5.3%. They want to get it to a level that they think is neutral in the long run. Right now, it's a restrictive policy rate. So the big question that the Fed has to answer is, what's neutral? They have written down a neutral rate of 2.8%. That's like the median. I think the neutral rate is higher than that. I think they're not going to be going down as low as 2.8%. So I would try to press Jay Powell on where he thinks neutral is and how fast he wants to get there.
And John, for what investors should take out of tomorrow's presser, or maybe it's the SEP, I mean, what do you think the key sort of takeaway is that people should be listening for from Powell, or does it matter more exactly what we're seeing in that dot plot?
Well, you know, so this is where the half versus a quarter plays out, because the messaging is a lot easier if they do a quarter. If they do a quarter, then they say, well, you know, we think the economy is fundamentally strong. We don't need to be in a mad dash to cut interest rates. We're going to do this in a really predictable way in increments of 0.25% every meeting for the next 8 meetings. That gets you your 2 percentage points. If they do a half, it raises all kinds of questions. And I think they're going to do a half. But the messaging is a lot harder, and he's going to get questions like, well, why are you moving so aggressively? Are you worried that the economy is slowing more than your forecasts imply? Isn't this an awfully political thing to do to move so aggressively right before an election? Are you acknowledging by going a half that you should have done something at the last meeting? So I think his messaging is going to be tougher doing a half than a quarter. So then you raise the question, well, why are they doing a half then? And the bottom line for me there is that they've just got work to do. They've got a long way to go to get to down 2 full percentage points in a year. And it makes sense to do your biggest cuts when you're farthest away from neutral. This is the farthest they're going to be from neutral, so they're doing their biggest cut first.
John, I want to switch gears and talk a little bit about Janet Yellen, because, of course, you wrote a book about Janet Yellen, and get your take on her next career move, John. And you'd be the guy to ask this. After Biden administration's term comes to an end, a new administration comes in, does she stick around, John? Because she's, in her words, she says, probably done. I think that's how she put it. What do you think?
Yeah. Well, thank you so much for bringing up my book. I appreciate that. That's very kind of you. She's done. She's done. I mean, she'll say probably done, but I'm pretty sure that she'll be walking off into the sunset after this election. One way or another. I'm not sure the exact timing, but there will be a transition to a new Treasury Secretary. And, frankly, she's had a very kind of long and one could say exhausting career. She was a Fed chair. She was the chair of the Council of Economic Advisors back in the late 1990s. I think what she wants right now is a break. And I think that's what's going to happen. I think she's going to kind of go quietly off for a little while and maybe sit in some chateau in France and drink wine and eat some nice food for a little while.
That sounds great. Yeah, that sounds great.
And you could say that she, depending on kind of your view of Janet Yellen, you could say she's earned it after all this work. But she had the financial crisis when she was at the Fed, and she had an inflation crisis and COVID. I think she wants to take a little time off.
How would you, John? Just as something, you did write the book. I mean, how would you grade her tenure as Treasury Secretary?
Wow, that's, maybe that'll be the version of the second edition. I got into some of this in the book, but we were only a couple of years into it. It's a very mixed report card, to be honest with you. Obviously, she has inflation on her watch, and the Biden administration did a lot of fiscal stimulus that in one way or another contributed to the inflation outbreak. You could have a discussion and a debate about how much it was a factor. The Biden administration will say, no, it was supply shocks, that they were really supporting an economy and they did what was needed. I don't completely buy that. I think the American Rescue Plan was very aggressive. She wasn't entirely supportive of it, but this gets to the other, I think, most challenging part of her tenure, which was the challenging part of her tenure when she worked in the Clinton administration, is she's not a political person. And, I think the record books will show that getting on the same page with the Biden administration was a challenge for her, and with the White House was a challenge for her on many different occasions. I mentioned the American Rescue Plan. That's something I document in the book. That plan was devised before she even became Treasury Secretary, so she didn't have a lot of say in it. And the White House was very, very often making political choices, and she's really more of a policy wonk. And so they just weren't on the same page all the time. And I think that will go down in the history books as one of the bigger challenges of her career.
All right, glass of wine, Chateau, France. She's earned it. John, thank you so much.
I wish I could say the same thing for 2025.
We all do, John. I'm right there with you. Thank you for joining the show. Appreciate it.
All right, thank you.
Time now for What to Watch, sponsored by Tasty Trade. Let's start off on the Fed. It is finally here. The FOMC's interest rate decision for September is tomorrow, and we're going to see whether the Fed's potential interest rate cut is 25 or 50 basis points. That decision will come at 2 p.m. Eastern, and we'll also get an updated dot plot from Fed officials after the decision. Fed Chair Jerome Powell will hold a press conference at 2:30. Yahoo Finance's coverage tomorrow will start at 2 p.m. Eastern.
Moving over to housing, monthly housing starts and building permits numbers for August are coming out in the morning. Economists forecasting both numbers to tick up. housing starts to 1.32 million, and building permits to 1.41 million. This coming after homebuilder confidence for September increased today for the first time in 4 months. The latest data giving us more insight into the housing market as elevated mortgage rates continue pushing potential buyers to the sidelines.
And finally, we're going to get earnings from General Mills. That's before the open. Company reporting results for the first quarter.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 2 p.m. Eastern for all your coverage leading up to Jerome Powell's press conference and after the closing bell.
But don't go anywhere on the other side of the break. It's Asking for a Trend. We've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. A record day on Wall Street that wasn't. The S&P 500 finishing near the flat line even after hitting a record high earlier in the session. And all eyes, of course, on the Federal Reserve, the central bank, set to kick off its easing cycle with a rate cut tomorrow. But the question remains whether it's going to be 25 or 50 basis points. Plus, a closer look at the software space. Salesforce hosting its annual Dreamforce conference. We're going to hear from the CEO of an up-and-coming competitor in the sector. Salesforce's annual Dreamforce event kicks off in San Francisco. A software company unveiling a shift in its AI strategy as artificial intelligence shakes up the industry. Amid that shakeup is an open door for new software competitors such as Creatio, with a $1.2 billion valuation. The unicorn status startup is looking to lead the enterprise no-code market. Catherine Kostirva, Creatio CEO, joins us now to discuss. Catherine, good to see you.
Good to see you, Josh. Thank you for having me.
So, Catherine, for viewers who may not be familiar, just walk us through Creatio. What's the problem you're solving for there?
Absolutely happy to do that. Listen, not many people know, but in the world, the population of software developers is 25 million people, which sounds like a big number, but in reality it is not when you think about the demand for automation. There are 500 million apps that need to be automated by those 25 million software developers, so math doesn't really work there. And the question is how to solve this issue, and the solution is engage knowledge workers, non-professional software developers. We call them knowledge workers or citizen developers, or people like yourself, for example, who have never been coders in your life, but actually—
You just tell by looking at me. You just knew right away.
But actually automate your workflows and build your own apps and build your own software. And now we have Gen AI that is helping us to do it even faster.
And so, Catherine, when you say no code,
Yep.
in layman's terms, you're giving tools to workers so they can build, automate their own products?
100%, yes.
Okay.
Like back in 80s, it was high code. You had to be a professional developer in order to actually create an application or automate your workflow. And then the era of low code came, it's rapid application development. And then 10 years ago, when Creatio was founded, we created this term of no code, when you actually just drag and drop and design your software, not being a professional software developer. And what we're doing right now is actually reimagining the world of no code when AI builds the software for you.
And what is growth like right now at the company, Catherine? Give us a sampling of some of the customers.
So as you just mentioned, we raised $200 million at $1.2 billion valuation in June to invest into AI, because that's where we see the future of automation in the workflow space. And we're growing 50% year over year, despite the market conditions.
Top line growth of 50%.
Top line growth 50%, 50 year over year, with 800 partners in 100 countries of the world. So the reason why we raised this capital of $200 million is to invest in AI, but also invest in our partners, system integrators in 100 countries of the world who implement Creatio, who support our local clients in all those countries.
And when you say invest in AI, Catherine, how do you see AI, Gen AI, impacting, changing the company, the industry you're working in?
Massively. So from one side, there are two aspects of it in our particular case. One is creating those apps, building those apps. And even right now, we have our AI command center where you can create your own workflows and applications using Gen AI. As we say, English is the future coding language, and we see that AI is going to be a bigger revolution on the market than even internet was many years ago. And the other part is actually raising productivity and efficiency of knowledge workers who use this software for case resolutions, service management, call center management, marketing, sales automation, you name it.
Question here, we have a Fed decision tomorrow. Lots of questions, Catherine, about the economy, about the labor market, the macro. I'm just curious from the lens of your company, what are you seeing out there?
We're actually seeing that the companies are starting to wake up and become much more flexible with their budgets. We haven't seen it previously. Right now, we do see a very positive traction in terms of investment into technology, into the innovation. So that's a positive for us.
Looking down the road, what do you see ahead for Creatio? Is it an IPO? Are you open to someone coming along with a nice acquisition offer? What do you think?
We're building an enduring company, Josh. So it's going to be a lasting company, again, with the growth that we deliver right now. We don't have any other plans but to grow the company as much as we can across the globe.
Catherine, thank you so much for coming in and being on set.
Thank you very much
Appreciate
for having me. Thank you.
U.S. stocks, a little change as investors look ahead to the Fed's decision on rate cuts. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Well, thank you, Josh. About the middle of the day, finally got a notice that the S&P 500 had notched an intraday record high, and that was the first in several months. We see here, this is my first takeaway, S&P 500 back to records, but maybe I should have only said record because it actually did not close at a record closing high. It just hit an intraday record high. Slight difference there, but my point in bringing that up is we have this big Fed decision tomorrow, this big catalyst, and we're right at highs, so we could either go higher, right, or lower. And maybe it's not going to be as simple as that. There's always some back and fill, but I think it might be as simple as that. So, you take into consideration what's happening with the S&P 500. You've got that calculation plus the equal weight index at these record highs. Things seem like they want to scream higher, but we've been talking about the seasonality is bad for stocks right now. So we're kind of at the knife's edge.
Let me ask you this. We were going to do 25. I thought that was baked in. Then the journal comes along and says, you know what, it's actually a close call. Could be 25 or 50. If we get the normal 25, what do you think the market reaction is? Do you think it's a disappointment?
No, I think the disappointment would actually become fear if the Fed hiked 50 basis points and seemed a little bit overly concerned. If Powell appears too concerned tomorrow, that just stokes recession fears. So the risk of 25 basis points, I think, is probably less than 50, but that's a decision Powell's going to have to make tomorrow.
Right, we'll see.
We shall. Let's take a point number 2 here, and that is everyone loves a Mag 7, but a little bit less than before. And what I'm talking about is the B of A Global Fund Manager Survey. I love this survey. They send it out every month to these money managers that manage about 2/3 of $1 trillion. They send back their responses, and here is the most crowded trade. Now, 46% have long Magnificent 7 stocks as the most crowded trade. We haven't been talking about concentration as much as we usually, or as much as we were in the beginning of the year, because it's kind of fallen off. And in fact, this number, 46%, used to be 70% only 2 months ago. So the concentration is going in the right direction. And that's the same story for short China equities. I think long gold is actually on the way up. We'll talk about gold in a second. And then remember the yen here. Well, that's 2%. I'm not seeing that much action there.
No. Look at the Japanese yen, crowded short, blew everything up.
Yeah, we were talking about that for a while, and we got ahead of it. It happened, and then it's just in the rearview mirror.
Right.
There might be an aftershock, but I'm not seeing any evidence of that just yet.
All right, number 3. Look at this, silver.
Silver, it's coming for gold. Not an absolute price, because silver is still around $31 an ounce. Gold is around $2,600 an ounce. But there's something called the silver-gold ratio, and I want to take a look at this silver chart. This is spot silver going back to 1949, actually, and you're going to see 2 spikes here of $50 a piece. The first happened in the 1980, and that was the Hunt brothers, a famous story. I'm writing about it in the morning brief, so check that out tomorrow. Hunt brothers cornered the silver market, $50 an ounce. Global financial crisis lead up to it. We had commodities going wild with inflation, not as much as now, inflation as we had in 2021, but still high inflation. Got another $50 push there. Now silver is just itching to go higher, and there's something called the gold to silver ratio, which is also in favor. It's moved in favor of silver here. So the stars are aligning towards the silver breakout, but the thing is, this is a very long-term chart, and it could still be several months. It could even be years before we finally realize that. It just looks like there's a possibility of it happening very soon.
All right, Jared Blickery. Thank you, buddy.
See ya.
Well, everyone has a money story that we're not proud of, and Yahoo Finance's newest podcast, Living Not So Fabulously, dives into these tales, helping you to become more grounded with your money by learning from others' journeys. Without shame, without judgment, join husbands and hosts David and John Auden Schneider every Wednesday at 12 p.m. Eastern. Stick around, much more Asking for a Trend still to come.
I'm Julie Hyman here with Akiko Fujita, and we are here at the Future Proof Festival in Huntington Beach, California, where we're hearing from a wide variety of different folks with their opinions on the markets and the financial industry. Among them is David Kelly. He's the Chief Global Strategist at JP Morgan Asset Management. He just got off the stage to my left, where he gave a long and very fascinating presentation about the state of the U.S. economy and markets right now. And so I'm delighted to talk to you following that really interesting presentation. So I would ask, first of all, since we are a couple days out from the Federal Reserve, what you expect the Fed to do. And I will say you seem to have a lot of underlying optimism about the U.S. economy, which I thought was notable as well.
Yeah, so I think the first thing to say is that overall it is basically a healthy economy. I mean, we've seen the unemployment rate is at 4.2%, the inflation rate, the CPI inflation rate 2.5%. You add those two numbers together, 6.7%. That is lower than it's been 84% of the time over the last 50 years. So I think the Federal Reserve really should, they shouldn't have too much angst about this. They should say, look, we're kind of where we wanted to be. The inflation rate has come down. And we always said that we could lower interest rates when inflation came down, even if the economy is doing okay. The economy is doing okay, but we're going to lower interest rates in recognition of the fact that inflation has come lower and it's not appropriate to have high interest rates anymore.
Julie cited the optimism in your presentation, even more so given the panelists that were on stage before you came on, saying that, look, we are going to see a slower growth economy right now moving forward. The time for the Fed to essentially flip the switch has now passed. How do you view it in that sense? It feels like the market has really been caught up on how significant or how many more of those cuts are likely to be. It sounded like you were saying, well, the economy is going to be okay regardless.
Yeah, so I do think that the Federal Reserve, first of all, I don't think they should have pushed rates as high as they did. And I do think they should have started cutting slowly early on. I've always believed that. I think that they are too active in how they try to talk about or how they try to manipulate the economy. Having said that, though, they're not. If they cut rates aggressively here, they're going to undermine confidence, and that's the whole point about cutting rates. Cutting interest rates from a height, it's kind of like lowering a piano down from the fourth floor of a building. You got to do it slowly and carefully, because the biggest risk is that you freak people out. The biggest risk is people say, "Oh, I wonder why they're cutting rates so much. Maybe they're scared of recession, and so I'm now going to postpone the hiring I was going to do. I'm going to postpone buying the business I was going to do. I'm going to postpone taking out a mortgage because I think they're going to surely cut rates more." And that actually slows the economy. Eventually, when rates get low rates can stimulate the economy. The first few moves actually hurt the economy, not help it. That's why the Federal Reserve has such a hard time cutting rates and actually having it help the economy, because it actually hurts before it helps.
So, David, is that the biggest risk to the U.S. economy right now? Is that the Fed will not do this smoothly, do too much, or is there another risk that you're paying attention to?
I think it's the biggest known risk, but I will say that the history of the 21st century is really one of a lot of things you didn't expect actually happening. I mean, so we've seen, obviously 9/11 was terrible, and you had the great, when Lehman Brothers went under, and when you had the pandemic recession. These sort of shocks are really the sort of thing that actually make recessions. I think if the Fed gets it wrong, we'll have even slower growth for a while. I think people will worry about recession, but in the end, you've got to give me a reason why consumers stop spending. And I think it takes a lot to make American consumers stop spending.
Adding to Julie's question about additional risks here, we are less than 2 months out from the presidential election. Not so much the question about what's the risk and who gets elected, so much as that it just doesn't feel like the question about rising debt is necessarily being addressed in the conversation. You had a slide up there talking about those very risks. What worries you most when you look at the plans that have been presented by both candidates?
Well, I do. There are things that worry me. I think the thing that doesn't worry me is the debt itself. We absolutely need to deal with it, but what we've seen is the world has got a tremendous appetite for U.S. debt. Last year, the Treasury Department managed to raise $2.7 trillion of additional debt, and long-term interest rates didn't even go up. And so if they can do that, I think we can actually handle big deficits for a while. One of the things that worries me is if we got into a trade war. Both sides have embraced tariffs, obviously one side more than another, but tariffs are terrible economic policy. They are a magical stagflation elixir. There are very few things that can actually cause the economy to slow and push up inflation at the same time, and tariffs can do that. So if we had aggressive tariff policy to try to finance the deficit, that would put us into recession.
I mean, couldn't you argue that tariff war never ended, though? When you consider that the tariffs from the Trump administration have remained in place, specifically on China, you look at what Europe is doing, for example. They are following the same playbook as well. Is that where, what does that mean in terms of global growth if you're seeing the U.S., Europe, and others?
Yeah, so I think we did move backwards from globalization in the last few years. I think we obviously have seen some tariffs which have stayed in place, but the economy has now sort of adjusted to that. I don't think the economy has grown as fast as it would have done without that. But I certainly don't want to see a big escalation of this because, if we have a massive increase in tariffs like 10% or 20% on all imported goods, that will massively increase inflation. But it also slows trade because, the idea that it's almost like a 2-year-old's mentality. I can punch somebody in the nose and then you're shocked that they punch you back. Of course they're going to punch you back. And so what will happen is it'll kill our exporters too. So you manage to cause inflation and kill exports at the same time. That's why it's so dangerous. And I wish that neither party would talk about tariffs at all.
David, I want to bring it back to the markets and strategy here for a moment. You were talking about the 60-40 portfolio, which has been a big topic of conversation here, by the way, at this event. And if I read the slide that you were showing correctly, it seems like because of the outperformance of that portfolio over the past decade, it's not as likely to do as well over the decade from here.
Yeah.
So what should people do?
Well, I think it reminds me a little bit of a situation in 2000 where after a massive run up in equities and the bond market was looking pretty good, if you look at returns in a 60-40 portfolio over that decade, they're pretty crummy. And of course you could talk about individual sell-offs in markets, but the big problem is you started off with overvaluation. And so yes, I think that returns from 60-40 will be less great going forward. But again, if you take this long-term logic, you have to have the discipline to add international to a portfolio because we do think that in the long run that will give you better returns. And also look at alternatives. Things like infrastructure, transportation, some areas of real estate if you can find the right manager.
Well, that's a good, alts have been also a huge topic of conversation here. Alts meaning alternative investments. Do most people have access to that in enough size?
I think that's growing. I think a lot of firms, including our own, are trying to make alts more accessible. And part of that is actually producing vehicles like evergreen private equity funds so you can get in and get a full private equity exposure immediately and get out when you want, with some limitations. And then also the other half of it's education. We produce a guide to alts, guide to alternatives, and our goal is to try to clarify what's actually going on in these sectors, because I think the industry is full of jargon, it's full of confusion. We really want to work through these, make it easier for individuals. When we talk about accessible, it's got to be financially accessible, but it's also got to be mentally accessible, and we want to make alts clear to people.
Well, I thought your presentation that you did was very accessible, clear, made some great points. Thank you so much for joining us, David. Appreciate it.
You're very welcome.
Thank you.
Thank you.
It's David Kelly of JP Morgan Asset Management.
Hard landing, soft landing, no landing? Which camp are investors in as we approach tomorrow's big interest rate decision from the Fed? Yahoo Finance's Josh Schaefer joins me now with a closer look. Josh.
Hey, Josh, yeah, so we got a good look at this morning from Bank of America's monthly fund manager survey. And so what we're looking at here is investors that said that they believe the global economy will land in a no landing. That's in purple. You can see that's been coming down over the last couple months. Or investors that see a hard landing. That's in light blue. That's been coming up a little bit. So what we've been seeing there is investors hedging slightly on no landing was sort of, okay, the economy's outperforming. We think the economy is set to outperform, and that's where things sit. But now what we're seeing is an increasing amount of investors saying we see a soft landing. So 79% of investors saying that they see a soft landing. That is a pretty optimistic tone from investors. I asked Kevin Mon earlier on the show with us, Josh, what he thought of this, and he thinks that if we involve the Federal Reserve in this survey, it might be a little bit more negative. Let's take a listen to what he had to say.
Yeah, I think if you include the Federal Reserve in that survey, that number would have actually been lower. Why do I say that? I looked to their last summary of economic projections, where they were forecasting economic growth to stay around 2% for the next 2.5 years. They're not forecasting their core inflation number, which we know is PCE, to get back to their target 2% until the end of 2026. Yet they're forecasting 225 basis points in cuts prior to getting back to their inflation target of 2% by the end of 2026. What gives? I think, Josh, they're more concerned with the threat of a hard landing than they are with inflation staying above 2%.
So Mon suggesting there to us that essentially investors might be feeling a little bit more optimistic than the Federal Reserve is. Of course, Josh, we're going to hear more about how the Fed feels about the economy during Jay Powell's press conference tomorrow, and that's going to be a big part of what we're listening to.
Sure will. Joshua, thank you. And that is a wrap on today's Asking for a Trend. Have a great night.